G'day folks, welcome back to another review of natural gas for the weekend review. So before you go any further, make sure you hit that like and subscribe button to support the channel. As of today, March 15, natural gas production. BP plans to increase US natural gas production in response to rising domestic prices, aiming for an output of 2.3 to 2.5 million barrels of oil equivalent per day by 2030. In terms of price forecast, natural gas prices have more than doubled over the past year, driven by heightened demand and geopolitical factors. In terms of bullish indicators, rising electricity demand from AI data centers is increasing natural gas consumption. Mergers between power producers such as Constellation's acquisition of Calpine aim to enhance natural gas power generation capacity. Bearish indicators, infrastructure challenges, particularly in regions like Texas, may limit the ability to meet growing electricity demands. In Australia, regulatory hurdles and intertwined energy and climate policies are hindering the development of new gas resources, leading to potential shortages. In terms of AI data processing demand, the rapid expansion of AI data centers is significantly increasing electricity demand. The International Energy Agency forecasts that power demand for data centers and AI could double by 2026, adding electricity usage equivalent to that of Japan. In the US, data centers' share of electricity consumption is expected to rise from 4% to 6% between 2022 and 2026. This surge is straining power grids, especially in regions with high concentrations of data centers, leading to increased electricity prices and concerns about infrastructure adequacy. So we always start with the long-term trend. So we've got the monthly, the weekly, and the daily. So on the monthly, the average, the price is broken above the moving averages. Likewise, the CCI 150, and that's giving us a bullish signal on the monthly. On the weekly, likewise, it's been bullish now for a number of months and still rising. So again, bullish movement on the weekly. However, just be careful on the daily. We're seeing a bit of a retrace back towards the moving averages on the price, and also the CCI is broken below. Now that could just be a short-term retrace, so we'll have to wait until this confirms. Otherwise, we might see a steeper decline if it goes any further. In terms of the support resistance areas, you can see there it's bounced off that minor resistance at 49.30, and it's currently gravitated towards this diagonal ascending trend line and almost hitting this support level at 39.45. But again, predominantly on the CCI it's showing bearish move, and we may see it break below this if this continues, if this CCI continues. So we need to look at the micro levels or the 1 hour chart to get a better insight into what's happening there. So again, predominantly bearish on the daily, but on the hourly, you can see here, it's actually again hugging this diagonal trend line. But notice we did have a bullish divergence, higher lows on the CCI versus lower lows on the price. And that's anticipated to hit the minimum 23-38% Fibonacci range. So if we draw a Fibonacci between that low and that significant high before the divergence started, you can see there it's already hit that 23-38% level. Now this may rise further, but at the moment it's still respecting this diagonal trend line, and the CCI is also pulling back on the hourly as well. So again, we'll keep an eye on that. It could go either way from here, but again, neutral on the price, but bearish on the CCI. So I'll keep an eye on that in the short term. So this chart here shows you the back test based on the daily. We take trades long or short on the hourly. So here, for example, I've got the back test starting back here on the daily when the CCI was bullish and the price broke above the moving average band. So that's where you would have started taking long trades on the hourly. And what I've done here is I've used the CCI on the daily. So when it breaks into that moving average band, that's indicated by these crosses on the hourly. That's where you would have taken your profits off the table, no matter what position you're in. So up until that point, if you're trading on the stop loss approach, that's where each of the individual trades are happening, you would have generated $828 approximately. And on the average down approach, you would have generated $8,610. Now, the reason that's so high is because you've averaged down each of these positions. So where you start with one contract, then you double that and you add 2 contracts to the one. So you've now got 3. Let's look at this one, for example. So you started with 1 contract, you double it, you add 2 to the 1, you got 3. That's where 3. And then you double the 2 again. So 3 plus 4 is 7. And then finally you max out at 15 contracts. Next, we're looking at BOIL. So on the monthly, it's been bearish, and the price is rising, but it's still bearish below the moving averages. There's no CCI for it. On the weekly, we've got this long-term bullish divergence, higher lows on the CCI versus lower lows on the price. And end of last year, it finally broke through those moving averages and headed higher with new highs, more recent highs. So bullish movement on the weekly. Now on the daily, we've got this currently, it's actually had this bearish divergence, lower highs on the CCI versus higher highs on the price. Broke down, hit our target area, so you can break through that level. And it's now still in that moving average range, but the CCI, similar to natural gas, has broken to the downside. So predominantly, I would call it bearish at the moment on the daily. Now, if we go to the intraday chart, see what's happening there. We had another bearish divergence here, and the price actually fell. And again, it's respecting this diagonal ascending trend line, but again, neutral positioning at the moment on the hourly. But I'd wait for this to break to the downside on the daily to take short positions. When it's in that moving average range, it's probably a bit too early to, you can see there the moving average is still wide apart, giving us a bit of a bullish momentum. So you want to see it break to the downside, and you want to see it actually flatten out like it did here, then eventually turn to the downside, similar to what it did here on the CCI. So again, just avoid taking long or short trades until we see a more comprehensive view on the daily in terms of the direction. So this is the back test for BOIL. So what I've done here is I've got the long programs only, no short programs, and I'll explain that in a minute. But back here, we started back here on the hourly, which is indicated by this tick on the daily. So when the CCI broke, a fresh break above the moving average, and also the price, that's where we start going long on the hourly. That was indicated by this period here. So this is a stop loss approach, and you would have taken those trades and the average down approach, and average down with 39 shares. You started off with about, back there, that was about 15 shares, and here you would have had doubled it to about 39. Now, you would have closed it out when the CCI on the daily broke into that moving average range, indicated by these X's. So on the stop loss approach, that generated $242, and the average down approach at that point generated $538. Now, I've let the program run in this one, but again, you wouldn't be letting it run, because here you'll notice we've got a bearish divergence versus higher highs on the price that actually did fall back. Now, this would have been profitable on both the stop loss and the average down approach, but just notice, you don't want to risk it. So to be playing it safe, I like to get out, and when I see these divergence, probably avoid taking trades, specifically when you see a divergence. Also notice here we're seeing a divergence on the hourly as well. So yeah, just be careful of watching for any divergence. That's why divergence are very important to get out of trades, or even avoid trading if you see any of those pop up. So this is KOLD. So on the monthly, it's broken below the moving average range, giving us a bearish signal. There's no CCI for the monthly. On the weekly, again, very bearish, with the CCI still dropping. So bearish movement on the weekly. And on the daily, we've had this bearish move, but notice we've got this bullish divergence, and it's bounced off that support at 1621, just about entering into that moving average range of the price, but the CCI is already giving us bullish signals. Now, to monitor this and to see how far it could go, we will draw a Fibonacci from that low. We'll take it back to that high. So if it follows that Fibonacci range, we expect it to reach that area. Now, just be careful. You've got to be careful how you draw these Fibonacci's, because I like to take it back to the recent significant high of before the divergence started. We could take it there, but I'm just using it back to that level there. So it depends which Fibonacci it respects. But at the moment, I'm going to leave it there and see how far it goes. So at the moment, bullish movement, somewhat bullish to neutral movement on the daily. If we go to the 1 hour chart, see what the intraday is doing. Again, you wouldn't be going long in this case, because the daily hasn't broken above the moving average range on the price, even though the CCI has, the price hasn't. You want to see both of them break above to confirm the bullish move. But at the moment, you can see there we've got another bullish divergence, higher lows on the CCI versus lower lows on the price. That's already bounced. Now, it hasn't hit our target range yet. I've drawn a target there already, so it's still potentially rising, had further to go. And this is the back test for KOLD, and we've started the back test going short from this period when the CCI broke below the moving average, and also the price. So starting from there, and that's marked by this period here. and we would have closed it out when the CCI broke into that moving average range as marked by the X's. So at that first point, you would have been down by about $50 on the stop loss approach, and you would have been up by about $50 on the average down approach. You would have re-entered and so on. So now I've let this run through the whole period, but you can see there, had I let it run till today, the average down approach has generated 3,039 and the stop loss approach has generated 397. Just be very careful, because when you do the average down approach, you've got to make sure you've got enough money in your bank account for the drawdown. So just be cautious about that, and always stop your positions, close out your positions, especially when the daily goes against you. So lastly, what UNG. Now UNG is a fresh break above the moving average of the price chart on the monthly, and the CCI has been bullish now for a couple of months in that very narrow moving average range, broken above that. So bullish move on the monthly for UNG. On the weekly, we did have this bullish divergence on the CCI starting back in start of 2023 versus lower lows on the price. This is also broken higher, giving us a bullish momentum on the price and the CCI, so bullish movement on the weekly. But on the daily, just be careful, we've got this bearish divergence still in play, I'd say. It's already hit our minimum 23-38% range, but it's currently sitting in that moving average range of the price chart, although the CCI is broken below, so we might have further downside to go. And to see if that's got any potential for an upswing, we look at the micro charts. So go to the hourly chart. I've got the daily here as a reference. So you can see there we've also had this bearish divergence on the hourly versus higher highs on the price. That was a double top up there, and that's already come down, and now it's resting on this diagonal ascending trend line. So at the moment, the CCI seems to still be dropping. We may see this below this trend line in the coming hours. And again, this trend line was drawn some time ago in amongst those lows and in that period there. And for UNG, the back testing, the daily here, and where you would have started the back testing back here when the CCI broke above the moving average, and so did the price. I could have started back here as well, but I'm just giving you the demonstration here back at that point. So you would have entered at that point and closed it out when the CCI enters into the moving average range marked by the X. Enter another trade there and exit it again when the CCI enters there. Don't trade short during this period, or you want to make sure the moving averages are trending down as well. So that's why you want to trade short during this period. Back here, for example, you could have started trading short when the CCI started and the moving averages of the price started dropping as well. Here, enter another long entry there and close it out when the CCI breaks in that moving average range. I've got all the closed positions here marked by X. So the first close there, for example, would have generated $202 for the stop loss approach up here. And this one on the average down approach generated $329. Now I've left this run completely through the whole period, so it's not really 100% accurate to say stop there and start there. But let's assuming you let the whole thing run. The average down approach generated $989. The stop loss approach generated $341. Again, just emphasizing, make sure you've got enough cash in your account to make sure you account for these drawdowns. So you can see there was a bit of a drawdown in that period there when it maxed out at that level of that many shares bought. To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.